Hey, folks, it's your host, the boss of economics, back with another no-holds-barred, gloves-off, truth bomb extravaganza. Today, we're diving headfirst into the IMF's latest report on Asia's economy. Spoiler alert, it's a hot mess, and guess who's to blame? Yep, your friendly neighborhood governments and their brilliant economic mismanagement. So, buckle up, grab your coffee, or whiskey, no judgment, and let's steer into this economic dumpster fire, layer by layer, from point to surface, boss style. Oh, look, the International Monetary Fund, IMF, is back with its trademarked, Captain Obvious, advice, telling Asian central banks to cut interest rates to prop up their crumbling economies. Why? Because the global trade war, fueled by none other than the tariff-happy policies of the US government, is dragging Asia into the economic abyss. But here's the kicker, folks, the IMF is basically admitting that governments and their central bank cronies have utterly failed to prepare for this mess. And now, they're scrambling to fix it with the same old playbook: lower rates, print money, pray it works. Sound familiar? It should, because this is the economic equivalent of putting a band-aid on a gunshot wound. Let's break this down, boss style, from the nitty-gritty details to the big-picture disaster, and expose the real culprits behind this economic train wreck. And don't worry, I've got the latest data, the juiciest examples, and enough sarcasm to make even the most stoic central banker squirm. First off, let's talk about the elephant in the room. The US-led trade war, now escalated to a full-blown economic cage match under the Trump administration's genius tariff policies. The IMF is warning that Asia's export-driven economies are getting hit with a double whammy: weaker global demand and higher US tariffs. Translation: your made-in-Asia iPhones, cars, and sneakers are about to get a lot more expensive, and the region's growth is tanking faster than a lead balloon. The IMF's latest forecast? Asia's economy will grow at a measly 3.9% in 2025 and 4% in 2026. That's a cumulative downgrade of 0.8 percentage points from their earlier projections, the sharpest cut since the pandemic. But here's the real kicker: these forecasts come with significant downside risks, meaning things could get even worse if trade negotiations with the US go south. And let's be real, folks, when has Trump ever backed down from a tariff fight? Now, let's zoom in on the data. According to the World Trade Organization, WTO, global trade volumes are projected to grow by just 2.7% in 2025, down from 3.3% pre-tariff escalation. And who's getting hit the hardest? Asia, of course. Export-driven powerhouses like South Korea, Vietnam, and Singapore are seeing their trade balances hemorrhage. For example, South Korea's exports to the US dropped by 12% year-on-year in Q1 2025, per the Korea International Trade Association, thanks to tariffs on semiconductors and autos. Meanwhile, Vietnam, the poster child of China Plus One manufacturing, saw its export growth slow to 5% in 2025, down from 15% in 2023, per the General Statistics Office of Vietnam. And who's to blame for this mess? Governments, that's who. The US government, with its tariff obsession, and Asian governments, for failing to diversify their economies away from export dependence. For decades, Asia has ridden the globalization wave, but now that the tide's going out, we're seeing who's been swimming naked. Spoiler alert, it's everyone. So, what's the IMF's big solution to this government-made disaster? Oh, just the same old central bank trickery: slash interest rates, weaken currencies, and pray the magic money tree saves the day. According to IMF Director Krishna Srinivasan, Asian central banks have room to lower rates because inflation is either at or below their target ranges. Translation: governments have already tanked demand so badly that inflation isn't even a problem anymore. Congratulations, policymakers, you've officially broken the economy. But here's the problem, folks: cutting rates isn't a silver bullet, it's a double-edged sword. Sure, lower borrowing costs might boost domestic demand, but it also risks weakening Asian currencies, especially if the US Federal Reserve keeps rates high. And guess what? The Fed has already signaled it's in no rush to cut rates, with the latest Fed funds rate holding steady at 5.25% in April 2025, per the Federal Reserve's latest minutes. Meanwhile, the US dollar is flexing its muscles, with the DXY dollar index up 8% year-to-date, per Bloomberg data. What does this mean for Asia? Currency carnage. Take Thailand, for example. The Thai baht has already depreciated by 10% against the dollar in 2025, per the Bank of Thailand, making imports more expensive and stoking fears of imported inflation. Or look at Indonesia, where the rupiah hit a 5-year low in March 2025, forcing Bank Indonesia to burn through $15 billion in reserves to prop it up, according to Reuters. And let's not forget the IMF's brilliant advice: let the exchange rate be the shock absorber. Oh, sure, just let your currency tank, let your citizens' purchasing power evaporate, and hope for the best. Meanwhile, governments sit back, twiddling their thumbs, pretending they didn't cause this mess in the first place. Classic. Now, let's dig into the deeper economic rot that governments have let fester. The IMF is waving red flags about deflationary pressures in countries like China and Thailand. That's right, folks, demand is so weak that prices are actually falling, which sounds great until you realize it's a one-way ticket to an economic death spiral. Businesses cut prices, profits tank, wages stagnate, and consumers stop spending because why buy today when stuff will be cheaper tomorrow? In China, the Consumer Price Index, CPI, has been flirting with negative territory, with a year-on-year decline of 0.2% in February 2025, per the National Bureau of Statistics. Thailand's not faring much better, with CPI growth at a measly 0.5% in Q1 2025, per the Bank of Thailand. And why is demand so weak? Because governments have failed to stimulate domestic consumption, instead relying on exports to prop up their economies. But wait, there's more. The IMF is also warning about high budget deficits post-COVID, urging governments to keep fiscal support targeted and time-bound. Translation: governments have already spent like drunken sailors during the pandemic, racking up debt, and now they've got no room to maneuver. According to the Asian Development Bank, ADB, Asia's average public debt to GDP ratio hit 62% in 2024, up from 48% pre-COVID. In the Philippines, for example, the debt-to-GDP ratio soared to 65% in 2025, per the Bangko Sentral ng Pilipinas, leaving little room for stimulus without risking a credit downgrade. And what do governments do when they're backed into a corner? Blame everyone else, of course. It's the trade war's fault, it's the Fed's fault, it's the IMF's fault, anyone but the policymakers who've been asleep at the wheel for decades. Now, let's zoom out to the big picture, because this is where the real satire kicks in. The IMF is urging Asian economies to look towards their domestic economy to drive growth and undertake necessary structural reforms to boost consumption and investment. Oh, sure, just snap your fingers and fix decades of policy failures overnight. Why didn't anyone think of that before? Here's the harsh truth, folks, Asian governments have spent years prioritizing short-term growth over long-term resilience. Take China, for example. For decades, Beijing has juiced its economy with infrastructure spending and export subsidies, while household consumption as a share of GDP languishes at 38%, compared to 68% in the US, per World Bank data. Or look at India, where bureaucratic red tape and labor market rigidities have stifled private investment, with gross fixed capital formation stuck at 28% of GDP in 2024, per the Reserve Bank of India. And don't even get me started on Southeast Asia, where crony capitalism and corruption have turned structural reforms into a punchline. In Malaysia, for instance, the 1MDB scandal continues to haunt public trust, with Transparency International ranking the country 57th out of 180 in its 2024 Corruption Perceptions Index. Meanwhile, in Thailand, political instability has delayed infrastructure projects, with the Bangkok Post reporting that $20 billion in public works remain stalled as of April 2025. So, when the IMF talks about structural reforms, what they're really saying is, hey, governments, stop screwing up your economies. But let's be real, governments aren't going to change. They'll keep kicking the can down the road, hoping the next crisis magically fixes itself. So, there you have it, folks, from the trade war tariffs to the currency carnage, from deflationary death spirals to debt mountains, this entire mess is a masterclass in government incompetence. The IMF can sugarcoat it all they want, talking about credible policy frameworks and independent central banks, but the truth is, Asia's economic fundamentals are only better than the 1997-98 crisis because the bar is so low it's practically underground. Here's the boss's take: governments caused this recession, and now they're expecting central banks and citizens to clean up their mess. Lower rates? Sure, but that just kicks the can down the road. Structural reforms? Great idea, but good luck getting corrupt, inept policymakers to actually do it. And in the meantime, who suffers? You, the ordinary citizen, watching your savings erode, your job prospects shrink, and your cost of living skyrocket. So, what's the solution? Easy: hold governments accountable. Stop swallowing their excuses about external shocks and global headwinds. Demand real reforms, not empty promises. And maybe, just maybe, stop electing politicians who think tariffs are a substitute for economic strategy. Until next time, this is the boss of economics, reminding you, when governments tank the economy, it's not a bug, it's a feature. Stay sharp, stay skeptical, and keep watching Boss Economics World, where we tell it like it is.